Good morning and very warm welcome to Financial Fitness Fridays. This is the fourth in this series, the autumn series. Thanks for joining us today. Our specialist subject today is mortgages and remortgages and buy-to-let, all those kind of good things. So I do have an excellent financial advisor, young chap called Ash Manning, who's got a lot of experience with mortgages, so he's really looking forward to sharing some of those with you. The plan for today is that we're going to take up to half an hour. That's the official hard stop for the session today. It's done in a live talk show style. We think people kind of getting a little bit zoomed out, with slides and things. So we decided to make it more human, have some conversation, have some Q&A. So what we're going to do, I'm going to set the scene, and I'm going to introduce Ash. And I'm going to ask you a load of questions that are preset because we've done a bit of research and listened to your questions from previous sessions. What we'd love you to do at the end of the session, if you wouldn't mind, please, is give us some feedback. We're going to send you a feedback link, and if you just let us know what you thought of it, what areas you think you liked, what areas you didn't like, if there's improvements we could make, anything at all that can help us try to make this a better experience going forward. This is the last of the autumn series, but we will be doing a Christmas special on December the 11th. So watch out for that one, and then we'll probably be back in February next year. Hopefully the world will start to look a little bit more normal by then. So the subject is mortgages, and I'm not an expert in mortgages. I'm a general kind of practitioner in finance. I look at everything from a financial well-being perspective, but I do know. I mean, I was fortunate enough to grow up, in the 70s and 80s, and that was when a lot of property ownership transformed. There was a big boom of property purchasing at that time. The government was selling off council houses at a very reduced rate. I think they were like a 2/3 reduction at the time, and so it really encouraged a massive property boom and a property purchasing boom. And it's kind of become the norm. People, in our country, people tend to want to buy properties, where in other places in Europe they tend to want to rent. So it's just the culture we're in. But a mortgage is definitely the biggest financial commitment that you can take on, for sure, for most people. And a lot of people try to do it themselves, and it can be dangerous. Now, I looked at some research a couple of years ago. I think it was Which magazine, and they did some analysis of people that did DIY mortgages, and it turns out that only about 1 in 4 have got the best deal for themselves, because there's a lot of kind of headline rates which attract us in, but we don't always know what other things to look for. Can be a problem. And mortgages they're a debt, of course they are, but they're classed as a good debt, or they're classed as maybe an investment, because typically and hopefully what you'd have is an interest on a mortgage which is less than the appreciation of the asset, so the house going up, and generally that is not a bad thing. People talking about fixed rates, we're going to talk about that today as well, and I think that's really important for financial well-being. I mean, when I first took a mortgage out back in 1987, my interest rate's 15%. I'm now looking at very, very low rates, looking at 2s and 3% fixed for significant periods. It's a very different world indeed. But the good news about fixed rates is the control you have. You don't have the Bank of England controlling your disposable income, because if they put interest rates up and you're on a tracker or you're on a variable rate, then you could find that your income's being eaten into. So also we want to give you a little more knowledge about mortgages today, lots more knowledge, because when you've got more knowledge, you feel more in control. When you feel more in control, you feel a lot less stressed, okay, a lot less anxiety. So that's really important. So without further ado, I think I'm going to introduce Ash. Ash, are you there?
I am indeed. Good morning, Darren. Hi, everybody.
Oh, brilliant. Thanks for jumping on today, Ash. Really appreciate it. So Ash is one of our financial advisors at Foster De Novo. But what I also want to say about this event, this is not a sales or a marketing event. Obviously, it's good for our PR, but we are not selling any product. We're not selling any proposition. We're not leading into anything here. Today, we're just going to be sharing pure financial wisdom. Hopefully, there's plenty of wisdom inside that mind of Ash there. So Ash, thanks again for coming on board. I'm just going to kick off with some questions, if that's okay. So
yeah, great. Sounds good.
Brilliant. Okay, so the first question I've got, I think it's a very popular one, first-time buyers. Okay, so what kind of guidance would you give first-time buyers starting out, and what support's available? And I've got a couple of questions within this as well. So just start there, really. So what advice would you give them starting out? What support is available for first-time buyers?
Yeah, fine. So there's quite a bit of support out there. It's obviously tough for first-time buyers at the moment. So We've got some support with ways they can save their deposit and also try to help them to get onto the ladder. So if we talk about deposit, first of all, there's the Help to Buy ISA, which has stopped for new applications at the moment. But for those who may have opened one, they've still got until the end of 2030 to get these 25% bonuses, which basically just meant that if you were saving in these Help to Buy ISAs, your solicitor, when you come to do the purchase, could apply for 25% extra to go towards your first home. If you wasn't one of those lucky people, then you've still got what's called the Lifetime ISA, or sometimes you may even get them called LISAs. But it's aimed at people who are between 18 and 40. And if they're saving for their retirement or their first property, you can still basically put up to £4,000 into these ISAs per year. And you basically get a £3,000 extra just thrown in on top of it, which that just helps you build up that deposit, which is really helpful.
So if there was a couple, they could have a LISA, a lifetime ISA each. You put in £4,000 a year each, plus the 1,000 each.
Correct.
Okay, so that's not a bad strategy to try to build up a deposit quickly.
Yes, absolutely, which for some people that can be the stumbling block. We then sort of move on to some of the schemes to help people buy the property. I think obviously lots of people would love to buy on the open market and probably that's their first go-to. But sometimes if they don't have a big enough deposit or their incomes aren't quite high enough, then there are schemes available. So one of them being shared ownership. So shared ownership, it's typically through housing associations where you're normally buying somewhere between 25% up to 75% of a property. They'll look at how much your income is and how much you can afford to be purchasing. So you'd basically be left with part mortgage and you'd be paying rent on the remainder.
Would that mortgage be with a typical lender or would that be through the housing association?
No, it'd be for a typical lender. They're normally specific products, but they're still very attractive. And what I love about shared ownership is you can actually do something called staircasing. So that's, if I was getting shared ownership today, they might deem my affordability, I can only afford 50% of a property. But as I start paying down my debt or my income starts going up, I can start staircasing my bigger shares of this property. And sometimes you can end up with 100% of that property further down the line, which is great.
Great way to do it. And is there anything else out there for people?
Yeah, so Help to Buy. So Help to Buy, the first lot of that is coming to an end this year, but there's a new scheme which is coming out for first-time buyer specific. But Help to Buy works a little bit different. It's very focused on new build properties. So at the moment, you don't have to be a first-time buyer. You just have to not own any properties in the background. But there'd be all the developers that are building properties up and down the country. There'd be a certain portion of those properties which are eligible for Help to Buy. And with Help to Buy, you can basically look to apply for 20% equity share or 40% if you're in London. And that 20 or 40% will go towards your purchase price. So you can probably get a nicer property than what you may have been able to afford without it. Great news with Help to Buy is you're not paying any interest on that 20 or 40% share for the first 5 years. So it literally is interest free. After 5 years, there would start becoming interest at 1.75%, which goes up annually. But at that point, you might be able to buy them out or perhaps sell and move on to another property anyway. So
can you just go back to that point again? So after 5 years, what exactly happens?
So you'd start paying 1.75% interest, which then goes up with inflation, which is RPI plus 1%. The new scheme which is coming out just for first-time buyers, they do calculate the interest after 5 years a little bit different. So there are a few minor adjustments, but the main changes is it needs to be first-time buyers only going forward. Plus, there's now going to be regional caps on the maximum purchase price. So depending on where you are buying in the country, they've done a bit of analysis and looked at what the average first-time buyer property was in each area, and that's now the new cap.
So just to clarify then, so I thought, wrongly, that after 5 years you then had to sell or remortgage and give the government back that interest-free loan. So that's not the case. No,
it's not the case. I think for some people, it depends on sort of how bigger that share is of 20, 40% and what that money value would mean per month. I think a lot of people probably would be looking to maybe sort of sell and move away from the Help to Buy, or buy a bigger share. So normally you can buy, if you own over 40% of the government, you can sort of start reducing that to 30, 20 and 10. It's done in 10% thresholds.
Okay, that sounds really brilliant. I do have a slide here. I think I might share it because it just kind of puts it into, I think pictures paint 1,000 words.
Yeah, indeed.
Can you see that one there, everybody? Can you see that, Ash?
I can indeed, yes.
Yeah, so this is a £250,000 property in the London scheme, where the deposit would only need to be 12,500 as opposed to maybe 25 or more. I mean, typically at the moment, what is it 10% now you can get deposits with, or is it higher?
Because of COVID, things have got a little bit stricter. So beforehand, you could usually go in with a 10% deposit and maybe the odd 5% deposits, but there wasn't too many around apart from using these schemes. On today's market, there's a few lenders who are now entertaining 10% deposits again, but some may be asking for 15% as a minimum.
Right. So on this one then, because the risk is lower to the lender, you can get away with a 5% deposit. That means the loan from the commercial lender is 55% of the total value of the property, which means you don't have to be earning so much to be able to afford to borrow that, because the rest of it, this is the London one, is a 40% free loan from the government for that 5-year period. So that kind of shows people that they could get onto a £250,000 property with a relatively simple deposit and not have to borrow too much in those early days. Is that a good way of looking at it there?
It is, and if just add one more quick thing, because you're only needing a 55% mortgage as opposed to a 90% mortgage, we'll come on to interest rates a little bit later, but it now means you're much lower risk at the bank and you're going to get a much better product as well.
Fantastic. Okay, now we are getting a few questions coming in, so what I'm going to say to the audience, please pop your questions in. If in the half an hour we get a chance to answer some of those questions, we will. Okay, if at the end of the hard stop, I know some people do have meetings to go to after this because it's a formal half an hour, but we will stay around for questions afterwards for 10 or 15 minutes. So please stick your questions in now. You know, if they're pop into your head, let's get them into the Q&A session now, and then I'll start reading those out to Ash as we go through. Okay, thank you. Some people have already started. Great. Okay.
One more thing I was just going to mention on this topic, if we have time, it's just there's actually a way you can actually get 100% mortgage on today's market as well, which some people aren't aware of, which I think could be prudent. There's something, Barclays, they do something called a Springboard Mortgage. So it's basically for a family member that if they want to, instead of gifting you a 10% deposit, they may not want to say goodbye to that money. They can put 10% into a savings account with Barclays, which does produce interest for them. But the borrower, they can apply for 100% mortgage, and then the person who gifted that 10%, they get that back after 5 years. So it's actually, in essence, is a way of getting 100% mortgage at the moment as well for people who may have parents who could help them.
So that's a great way for the bank of mum and dad to help out. Yeah. I think I did some research recently, actually, and I think half of all first-time buyers are now using the bank of mum and dad. Yeah. I think the average contribution towards it was something in the region of about £20,000 or something, so it's considerable. And I also found out it said that if the bank of mum and dad were a lender, they'd be the 10th biggest mortgage lender in the country.
Yeah, I read that. It's incredible.
Get their money back over time, you know. Okay, now that mortgage you just explained, where you put the money in deposit account, is there a name for that?
So that's called a Barclays Springboard mortgage. So it's a separate account that they would open up, but they still get interest, and it's just released back to them after 5 years.
Brilliant. And so what's a guarantor mortgage?
So with guarantor mortgages, I get this asked really frequently, saying someone's income isn't enough. Can my parents help me out, or can someone else help me out? And the old traditional guarantor kind of died, but it was replaced with something that most people aren't too aware of. It's called joint mortgage sole proprietor. So what it basically means is you can have up to 4 people on that mortgage. So that's four incomes. But what's great about this option, so if we just paint a picture, boyfriend and girlfriend and their parents wanted to go onto the mortgage with them, they can use the parents' income to help them out. But what's so good about it is the parents can go onto the mortgage deed, but stay off the title deeds. The reason that's so crucial is because if you're a first-time buyer, you get stamp duty, help towards stamp duty anyway, stamp duty relief. But also, if the parents were buying a second property, there would be this 3% surcharge. So this is a nice way to avoid it.
Wow, you know your stuff, Ash. Brilliant, mate. Thank you very much. Okay, Bilal, there's just one other thing I think is relevant to this, because we're talking about first-time buyers. It's often young people, student debt. You know, I know that it's sort of different type of debt, but I do know, I did some research on it this week, and I found that on average, student debt is $35,000. The student loan company charges 6.1%. So it shows that some people will even create as nearly £6,000 of interest on the student debt before they even graduate, you know. And for people from poorer backgrounds who don't have so much parental support, they can be looking at as much as £50,000 of student debt. So how does that impact with a first-time buyer, or does it create any impact?
Yeah, sure. So when you go to banks, they're all going to offer you different amounts, which is one reason it can be good to speak to an advisor as opposed to just going to a bank who perhaps you bank with, because they're all going to help you out in different ways. But what those banks are going to do, they're going to do an affordability assessment to have a look at what incomes, what outgoings, and also they'll look at deductions on your pay slip. So with student loans, typically it's a salary sacrifice, or it comes off your salary. So you're getting sort of, so it's not such a big hit where, yes, you might be losing 100, 200 or whatever it may be. It's a portion above your 25%, 25,000 earnings. That just goes as a deduction. Depending on how much someone's earning, sometimes I find it makes no difference at all. But if I've got clients who perhaps aren't earning as much, then it can make a small difference, but it's not drastic.
But it's not something people should overly worry about then?
No, some people say, should I clear my student debt off? And usually not. I'd concentrate more on your deposits, and plus with student loans, because it's coming off your pay slip, you kind of get used to it anyway. And after, if it's 30 or 35 years, if it's not paid off, it disappears anyway. It's wiped. So I would normally concentrate on more just saving up for your deposit.
Brilliant. Thank you very much. Okay, so that's an excellent section. Thanks a lot. So the next question I have here is house prices following COVID-19. Is property still a good investment? Will they continue to go up in value? Will they drop? What's your thoughts? I've got a couple myself. I want to hear you first, Ash.
Yeah, sure. It's a really, really good question, and one that most clients are asking at the moment. So some articles or some economists that you'll read will talk about this kind of mini boom that we're in at the moment. The reason we're having a bit of a mini boom, which sounds so bizarre, we've obviously got all this bad news with COVID, and we know about people's incomes being affected. What the government have done, though, they've given us a stamp duty holiday until 31st of March next year. Because of that, it's a really big saving that you can be making on stamp duty tax when you buy a property. So now there's this big rush where people are thinking, oh, perhaps I might want to buy a different property now, or change location, get a garden if I move out of London, whatever it may be. But it's creating this big sort of buzz of, I need to now buy. So Land Registry, they're saying from August last year to this year, house prices have gone up 5.5%, and 2.5%. With Rightmove, they're saying in that same period, asking prices have gone up by over 5% as well. So we are seeing house prices go up. But putting a pessimistic hat on, we all know these things are coming to an end. Stamp duty holiday is going to end. Furlough and government support for income is going to end, which may lead to more job losses, and probably is likely to, which then could have a negative effect. So my personal answer to that, Darren, is you need to look at your own circumstances. If you're perhaps in rented at the moment, which is kind of dead money, still buying a property now could be a great investment, because even though we might see a dip next year, they should hopefully recover. Because I know some economists are talking about possible sort of 14% drops next year, but then you've got to look at the long horizon. You don't buy property just for 1 year's returns. You're looking at the longer outcome. And if you look at the next sort of 5 years predictions, some might be saying another sort of 14, 15% growth we could expect. So you need to look at your own personal circumstances.
Yeah, I think if you step right back, I mean, long term, I'm guessing it should be fine, because we still have a massive supply and demand issue, and our population is growing at several 100,000 a year still. So, there's probably still not enough houses out there for the amount of people. And whilst that's always the case, that will always drive up, prices. And I think the other thing was that London was seen as a safe place as well for people to invest. And so a lot of, foreign investors came in and put the property prices of London up considerably. So whilst those sort of things are going on, we're probably fairly safe on the long term, but, possibly with the uncertainty coming, there might be some turbulence in the next year or two, I guess.
Yeah, correct. I'd agree with that.
Okay. So what about people that have been furloughed recently? What can they do about getting a mortgage now?
Yeah, so this one, it's changed over the last few months. So for people who were affected with their incomes and were furloughed, lenders during the first lockdown, that they were allowing people to use their furlough income to apply for a mortgage. They wouldn't accept their normal salary. They would look at what they're actually receiving. So whether that was the 80%, or some employers may have been nice enough to top that up. But for this lockdown, lenders aren't doing that at the moment. They're asking people that they need to return back to work, and they probably need to return to work for at least 1 month so that we can show 1 full month's pay. The reason for this is mainly because whilst we've seen some people return back to work from the first lockdown, Some people's salaries may change or their contracts may have slight adjustments, and lenders are quite keen to see what that's going to look like for the future as well. So for employed people, you need to return back to work. For the self-employed people, there has been a big impact. Lenders are asking lots of questions about kind of how's the business been going this year, how they've been able to operate, what changes have they seen, and a lot of questions about kind of, well, especially next year, how they see their business kind of surviving throughout this sort of pandemic.
So something you mentioned in that answer was about people's capability of borrowing. In the old days, a lot of them still have in their head 3 times your salary is your amount you can borrow, 2.5 times joint. Someone's just got a question, just prompted me actually, is it 4 times salary roughly? I think that's all completely changed. I think just in very simple terms, explain how lenders assess it now, not just a multiple of salary.
Yeah, sure. And I can actually link that into the furlough question as well. So income multiples have disappeared because it's not a very accurate way of assessing someone's affordability. So they do these proper affordability assessments, which are a little bit more detailed, but their calculators are going to have an upper ceiling, a cap, which I would probably say for most lenders, it's around 4.5 times joint salaries. It is going to be split between kind of what's guaranteed, so people's basic, and if people are getting bonuses or overtimes, commissions, some lenders aren't accepting those elements at the moment. Some may still be, but they don't always take 100% of it. They may sort of cap your bonus needs to will only accept 50% of it, for example.
Yeah. Okay. So. Okay, yeah, I was going to ask, I think we're just because of time, I'm going to get on to the next question. So thanks very much for that, because I think a lot of people, there's questions coming through, and people are, want to know what's a good deal out there, don't they? Things like that. So fixed rates, let's talk about those. I mean, I've just fixed my rates. I'm not the mortgage expert like you might be, but I certainly know for my own financial well-being, I do not want the Bank of England dictating my lifestyle. So for me, that's my own personal choice. I've fixed 5 years. I can relax, and I know exactly what I've got to pay each month. So from that perspective, what's your thoughts on fixed rates? Still a good idea? And why would you take one? And what sort of rates are available out there?
Yeah, sure. I love fixed rates. So they're not right for everybody. So I would always take advice what's good. But what I love about fixed rates is it enables someone to budget. So as you mentioned, you don't need to worry about if Bank of England base rate changes, my monthly expenditure, which just brings good peace of mind. If you've locked yourself in for 5 years, you just know for 5 years, Darren, you don't have to worry about speaking to lenders again, shopping the market, maybe incurring remortgage fees. You just know, here's my amount I'm paying for the next 5 years. And whilst we get to the end of that 5 years, we'll have a little shop around again, but it's great for budgeting. With fixed rates though, it's not just as simple as saying, let's take a fixed rate. There's then so many options. So you've got 2-year fixed, 3 years, 5 years. There's even some lenders doing 7-year fixes and 10-year fixes. You normally pay a little bit of a premium the longer you fix in for, because you're sort of paying for that peace of mind and that security, but there's some really cracking deals. The way lenders will normally look at it is they'll look at your size of your deposit. So if you're going in with a 10% deposit as a minimum with some lenders at the moment, you're sort of deemed the high risk category. So you're applying for what's called a 90% loan to value product, which on today's market, you would be getting, it would be above 3.5%. So there's a bit of a premium. There's quite very high risk at the moment for some lenders because they're worried if prices might drop the next year and things like that. Whereas every time you go down a full 5% extra deposit, you'll go down to the next tier of products, and they typically drop by anywhere between 0.5% to maybe 1% down each threshold, to the lowest ones on the market. I've probably seen about 1.4% at the moment.
Okay, so I'm just thinking there. So we mentioned previously that there's this affordability thing. So there's quite a lot of analysis work doing on lending. Then you've got the fixed rates, which is the best one. So I suppose you have to look at the mortgage fixed rate much more holistically than just that product and just that property, holistically in terms of your financial life.
Yeah, especially when you're talking about your intentions as well. So just to paint one example, if I'm speaking to a couple who are buying their first property, perhaps at the moment they've got no children, but they know they want to start a family in a few years' time, and they may need to upsize, then it may not be best to take one of those 5, 7 or 10-year fixes, because when you fix in, there'd normally be, if you want to come out of that mortgage early, there'd be something called an early repayment charge, which is basically a penalty to come out of that mortgage early. You can normally transfer that mortgage. It's called portability. So transfer it to the new property, but you're sort of then tying yourself to that lender who may not be the best lender for that new property at that period of time, or might not be able to give you as much as another lender could. So I normally have a look at someone's intentions, how long they're planning to stay at their property, their finances, and everything else which may come into play a factor to then sort of give my recommendation advice on which products I think is going to be best for them.
Yes, it sounds to me, I mean, what I'm not doing here is promoting Ash here, right, guys? I'm not promoting Ash's services as an advisor. What I am saying, though, I am promoting the services of an advisor because, well, it sounds to me like a lot of people try to do this and do this themselves. There's too much to know. If you're not doing this full time, it sounds to me like there's a lot of mistakes that could be made. And that research that I read a couple of years ago, only 1 in 4 got the right deal. You know, that means a lot of people out there probably trying to cut corners and save a few pounds, but probably a stitch in time saves nine. I would suggest probably spending a few £100s on an advisor for that piece of work would be wise. Would you agree with that?
Yeah, absolutely, because it's very easy to obviously look online and just have a look at the interest rate and maybe the product fee which is attached. But when I'm actually making a recommendation to a client about which product they should take, there's something called a mortgage illustration document, which is actually about 5 pages long. And that's going to tell you everything about that actual product. And one thing which could be a mistake that clients could make is there's going to be overpayment caps with different products. So if I'm speaking to a client who gets bonuses or perhaps have lump sums that are coming in and they wanted to use that to pay down their mortgage quicker, lots of lenders either may not permit it or may restrict them to a 10% overpayment of how much they're borrowing. Whereas there'd be other products out there that perhaps have no caps at all, no limits, which would be a much better product for them. So I think speaking to an advisor to actually understand the situation, then make a recommendation, it makes much more sense.
Okay, good. I'm conscious of time. I might overrun a couple of minutes because it's a big subject. I've got a lot of questions, so that's great. Keep bringing your questions forward, guys. If somebody was looking for an advisor to advise on a mortgage, where would they find one? What's quick tips on that?
Yeah, so there's 2 good websites, one called Unbiased and one called Vouched For. Unbiased, it's kind of, they'll allocate you an advisor or perhaps give you a selection. Whereas Vouched For, it's more kind of you put your postcode details in, what you're looking for, and it'll tell you some local advisors. What I like about Vouched For as well is you can see all clients' feedback and comments that they've been providing on this person's advice. So you can get a bit more of an indication of whether they're good or not as well.
Which is like TripAdvisor to me. And I'm assuming that if you go to a bank, the advisor in the bank will only be able to recommend products that the bank offers. So
absolutely.
Yeah.
Which for me is just, it doesn't make sense because all banks are going to offer you very different amounts, have different type of products. So you as an individual, you could go to your bank and assume that's all you can borrow or that's the best option, but they're not going to tell you about any other banks. Whereas you go to a whole of market advisor, which is an advisor who deals with the whole of the market, you'll have one meeting with them and they'll do all the legwork for you to come back with a bespoke recommendation.
Brilliant. So the key thing there, the key advice there is find a whole of market mortgage advisor. Brilliant. Okay. Again, I'm conscious of time, but I can't let this one go because I know this is a hot question. Buy to let. Now, this has been hugely popular for the last 2 decades. You know, probably a lot of people have got a nice little portfolio built up. But what's changed? What are the pros and cons today of buy to let?
Okay, there's quite a bit to this answer. So mortgages or properties was always this sort of go-to haven of a good way to earn money back in the days, and which it still can be, but it certainly takes more planning now. We've had quite a lot of changes over the last sort of 5 years, which there's been some new regulations came in. So basically when you apply for a property that you want to live in, that's called a residential mortgage, and they're basically assessing your income and affordability. When you come to look for a buy-to-let, they may ask how much you're earning and what your situation is, but what they're more interested in to know is what the expected rental income is of that property. So you normally need around 25% deposit, so you get a 75% mortgage. But they would look at, okay, if you're borrowing 300,000, they'll put it through a calculation to say that property needs to be generating a certain figure per month in rent.
Yeah.
How that's changed is they used to look for about 125% coverage, whereas now that's increased to 145% coverage. What that's basically meaning in sort of real terms, though, is for certain places in the UK where the rents aren't sort of keeping up with the property prices going up, instead of being able to go in with 25% deposits, some clients I speak to for certain properties, they need to put maybe a 40% deposit down to make that property work.
Right.
So that's one big impact. There are more though.
There's 2 more. I think there's again, just high level. There's you better get tax relief on the mortgage interest.
Correct. So yes, where that's now been phased out fully. So instead of being able to, if you had £1,000 per month coming in rent and you had £400 interest on your mortgage, you'd basically only be paying tax on the profit, so that's £600. Whereas now you'd be getting charged tax on sort of the turnover, the full £1,000. There's something called, you get 20%, a flat 20% tax relief against that now, which for lower basic rate taxpayers, it may not make too much of an impact, but for higher rate taxpayers or additional tax rate payers, there's a big impact where things don't look quite as pretty. So it's basically meant, instead of just looking at always traditional buy-to-lets, there's specialist buy-to-lets which can sort of sort out that 145% coverage I spoke about. There's also something called limited company buy-to-lets, where some people may look to buy a company in a limited company now because of them being a higher rate taxpayer. It may work out more tax efficient, but again, get some tax advice and have a look at it properly to see which one's going to be the best route for yourself.
Fantastic, mega brain you've got there, Ash. Very impressed. We are slightly overrunning, but there was one other thing I just think we should mention, and that is capital gains tax on your buy-to-let property.
Yeah.
So you know that that's there. You know, it has been there. The thing to think about there, I guess, is that we you know, there's a lot of rumor at the moment coming out through the financial services industry, from government, that obviously different taxation. It's some easy wins for government on taxation, and it's possible for buy property now that the capital gains tax, when you sell it, might have gone up a lot. In fact, it might be leveled up with your income tax rate. The other thing that might happen is that your capital gains tax allowance each year may come down or disappear altogether. So just beware, get some advice, and actually understand what could happen in the future, because it might change your mind. If you're going to grow the capital value of that property, you're not getting so much interest, tax relief on the interest anymore, but also when you come to sell it. So you've really got to look at it like a business now and look at those two elements of taxation and then decide whether to do it. It probably will slow down the market considerably, I would imagine, which might actually slow down house prices, which might give young people in the future a bit of a chance. Brilliant. Well, I'm just going to finish off the last two slides because I've got to wrap these up, and then we're going to go into questions. I've got loads of questions, so thanks everybody for that. I do need to share screen because we are a regulated entity, and even though we're not selling anything, this is classed as a financial promotion. So I have to show you these slides just to finish off with. So that's that one. So next week, not next week, December the 11th, our Christmas special, budgeted and saving through the holiday season and into the new year. I'm talking to various people to help me out with this one as guests. They are financial coaches who really understand what's going on at the coalface at the moment out there. So we're just putting that together now. So that'll be December the 11th as a one-off, and then we'll be back probably in February, but we'll let everybody know. We'll promote all of that. So I do need to put this thing up here. This is the caveat because we are a regulated entity. But now I've done that, I can stop the share. If you are finished, and you've got to go now, good luck to you. Good luck on your financial well-being journey. I do hope you got something out of today. I really do. And all we ask that you do, and in return for us, please give us some feedback. If you thought it was a load of rubbish, tell us. If you thought it was great, make us feel good. But if you've got some other suggestions and ideas or whatever, just tell us, please. We'd love to hear from you, and then we'll fine tune these going forward. And hopefully, the plan is that we'll be doing this every quarter. We've got the winter one coming up in probably around February. So if we do a month every quarter, then there's always something to look forward to. Right. So thanks everyone for jumping on. There's still almost everybody's still here anyway. So lots of questions. I guess everyone that's asked a question is going to want to hear their answer. So I'm going to try to pick out questions which will help the whole audience. So some quick ones here. Quick question for you, Ash. Do you think they will extend the stamp duty tax break?
I think they'll review it. I'm really not too sure, to be honest. It's stimulating the market and it's keeping the market up, which is important. The government don't want the economy to crash. We have to wait and see. It's great there. So what I would encourage people to do is, if you're sort of nearing that point where you could look to take advantage, obviously we are running out of time. I wouldn't sort of bank your buck to say it's definitely going to be extended because they haven't declared anything at all at the moment. Brilliant.
Thank you. Another question here. With the Help to Buy scheme, when do you apply for the application to proceed? Is this once you have the mortgage offer? So kind of what's the steps and stages for people there?
Yeah, so it's good to speak to an advisor early on, where they will actually, they need to do two checks. They need to, one, find out how much you can borrow from banks. And also they'll do a few checks with the Help to Buy agent as well to work out how much you can borrow from them, because their calculators, they can differ. So we sort of need to check on both fronts. And then once you've actually found the property that you're interested in, it's again good to speak to your advisor, because certainly if it's a flat, there's going to be things like service charge and ground rent. So we'll need to factor that into all our affordability checks we've been doing before you put your reservation holding fee down. But then we'd apply to the Help to Buy first of all to make sure we get approved for that 20 or 40%. And in turn, we'd be applying for the bank. So I normally do them at a similar sort of time, to be honest.
Brilliant. Okay, so I just want to clarify a few things that people might have just misinterpreted along the way. Question here, I think it's important to just double check. How does the Help to Buy ISA bonus work if you can't use it towards solicitors' fees?
So it's actually towards your, so your solicitor applies for it, but it's for your help for your deposit. So if you've got an amount saved up, which there are going to be certain caps, your solicitor can apply to the government for these 25% bonuses extra. And that'll then go towards your conveyancing, your deposit as well. If it's not going towards that house purchase though, then you can't apply for them.
Okay, brilliant. Another quick question. I don't know if you're going to answer it, but you probably will. So what are the typical milestones in equity that unlock the best interest rates? Just a quick answer on that one, I guess.
Yeah, fine. So they normally go in 5% threshold, starting with 10% deposit down to 15. Once you normally get down to a 40% deposit, you're normally on that lowest tier and they don't fall any lower.
Brilliant, thank you. Somebody's here that's already got a property, or someone they know has. So what help can you get if you've already bought a house but would like a bigger property? What's the best way to do this financially?
So again, you'd be, if you're locked into a deal, you may need to look at whether it's going to be better for you to port that mortgage across to a new property and take a top up of that lender, in which case you can still go for an advisor, or you could speak to that lender yourself. Or if the early repayment charge isn't too big, it may be better to incur that early repayment charge when you come to sell the property and apply for a brand new mortgage, to look at how much equity you'd have left after all those expenses of selling, how much mortgage you can get, and now what that bigger property size is going to look like.
Okay, thanks very much. Wise words. So this person here, my husband doesn't work, so when we bought the house, we didn't put him on the mortgage. We're going to be moving again. He still doesn't work. If we put his name on the mortgage as well, how can that affect rates and deals?
Okay, so it may affect affordability. So it depends on how lenders will perceive it. Some lenders don't ask too many questions, other than if someone's over the age of 17, they'll need to sign a waiver form to say that if you stop paying your mortgage and they had to repossess, that person can't claim sort of rights to the property or squatters' rights. But they may not have held that person sort of as a dependent. A lot of lenders will do those. So whether they're on the mortgage or deemed as an adult dependent, it's still likely to bring your borrowing down a little bit.
Okay, thank you very much. So we have another one here. This one is, they missed the name of the setup where the parents can stay off the title deeds and not be subject to additional taxes.
So that's called a joint mortgage sole proprietor. There used to be only about 4 lenders doing it this time last year, but I've started seeing more and more lenders doing it. There could even be sort of around 10 now. They all have slight different ways they assess it and the way they'll look at it. And just one key example is some lenders might be very stringent to say a parent's age might, they can't go above age 70. So if they were age 60 already and you wanted a 20-year mortgage, certain lenders may say, no, we can't do that because your parents will go above age 70. Whereas some of them may say, if that parent's income is office-based or rental income based or pension, then they could take that up to age 80. So it's good to perhaps speak to an advisor, because they'll know how all these different schemes work in the sort of more particular detail.
Brilliant. So on the joint mortgage sole proprietor scheme, if the parents live abroad and they have foreign bank accounts, how can that work?
That would be extremely difficult. So they probably do need to be UK based with UK income, because if that's not the situation, you're normally looking at international banks who can look to use foreign income. There's a few banks, HSBC and a few others who they have certain criteria which may be a little bit more forgiving with foreign income, but it does become a lot more complicated. It may not be a possibility.
Brilliant, thank you. So here's one. This one I've actually had in the back of my mind many times over the years. This person says, my partner and I are looking to buy in the next couple of years. Mm-hmm. He's a first-time buyer, but I'm not. So I bought property when I was 21, but I haven't owned for over 10 years. I'm currently renting. So are you aware of any options where I could be considered as a first-time buyer if buying as a couple? Because the information they've got online's kind of conflicting. What is the situation there?
Yeah, so it depends if we're talking about stamp duty or products. So some lenders, they may do a first-time buyer products where you maybe get a lower lender fee or slightly lower interest rate to help people onto the market. Depend on the lenders. Some may say you have to have never owned a property, whereas someone like Nationwide, they actually have a period of time. I can't think if it's 3 or 5 years, but if you haven't owned a property in that period of time, you would then be eligible for these first-time buyer products again. Whereas stamp duty, the HMRC would say that you could have never owned a property if you want to take advantage of this first time. Obviously, we've got stamp duty holiday at the moment. Before that, first time buyers was also getting some stamp duty relief, but you both had to be sort of full first time buyers to be getting granted that tax relief.
Brilliant, thank you. Well done so far, because I am putting you on the spot with these questions because you're not prepared for these ones. So just a lot about you, and also what you just said there, kind of just again, emphasising the point. Really, there's too much to understand here. People really should get professional help when they're doing this. Is the biggest financial commitment they're ever going to embark upon in their lives. To try and do this yourself if you're not an expert, is probably unwise. Okay, is there an age limit for first-time buyers?
No, no age limits. There will be age limits for how old mortgages can go up to. So some lenders may take it just to state retirement age. I think 70 is the normal norm for most people, though, to say that you can take your mortgage up to age 70. So you basically need to have it paid off before that point. But some lenders may even go higher, 75, 80. I know a couple that even goes to 85 if it's sustainable.
Okay, I think we've got time for one more question before we then wrap up to finish at the 45 minutes. So somebody owns a house outright. What's the best way forward to buy a bigger property?
It depends if they're looking to sell that property or if they were maybe wanting to retain that property. So you could obviously sell, walk away with the equity as a deposit, or if they were interested in maybe keeping that property, you can do what's called a let to buy. So it's similar to a buy to let, except you'd be letting yours out to buy an onward property. So depending on what that expected rental income would be from that property, you could maybe withdraw up to 75% of that equity in that property, which you can then put towards the new property as deposit, and then take a new residential mortgage on the new property as well.
Brilliant. Okay, how are we doing? Well, I've got another 2 minutes. Right. Okay. So one final, absolutely final question. Somebody's mentioned the Panorama program this week. Panorama, it had a help to buy scheme with some issues with staircasing regarding the service charges on the rental portion. Anything you know about that? Anything to worry about?
So stair charging on these, the portion of the service charge and ground rent, is that?
Service charges on the rental portion of the, I think they're getting confused with help to buy schemes and then shared ownership, to be honest. So probably about shared ownership. The rental portion, there's some issues regarding service charges. Are you aware of those?
Apologies if I've got this wrong. So with so you can staircase on both help to buy and shared ownership. Shared ownership, you can go up in sort of whatever threshold you can afford, whereas help to buy normally needs to be 10%. If you're buying a freehold house, there's normally no service charge or ground rent. But if you're buying a leasehold apartment flat, there'd be service charge and ground rent. There is some, you'll see some articles about ground rent in particular, that sometimes they're fixed for maybe the first 10 years, but then they can escalate quite quickly, where there has been a little bit of research into that to kind of say, there's people profiteering from ground rent, which isn't the intentions of it. So that may change, or I have even heard it could even be abolished. Service charge is normally more linked to the upkeep of the property. So if you've got a block of flat, it's upkeeping all the communal areas, or if it's one of those sort of plush big apartments with concierge and gyms and things like that, then your service charge is normally to cover those expenses. But that can affect your affordability as well. So be mindful of those, which can escalate as well.
Well done, Ash. We didn't catch you out at all today. You managed to answer every single question. First of all, a very high standard. There are a few questions outstanding. Some of them are quite individual. So what we'll aim to do, if you haven't had your answer questioned on here, we will aim to just pop an email out to you, just to answer some of those questions if you've got that, if you need that covered off. That's great. So thank you very much, everybody, for jumping on. That's the end of it for today. Look forward to seeing you. Some of you on December the 11th for the Christmas special. What was a message from my team? Oh no, just lots of thank yous. That's great. Thank you again to Ash. I think you were absolutely excellent today. One of the best events we put on in this series. So really, really pleased. And all I can say to everybody is please do the feedback for us. Okay, we do want to fine tune this. If you could really do that, I'd really appreciate it. Just take you literally 1 or 2 minutes just to give us that feedback. Really appreciate it. And good luck with your journey to buy your own property. Take care, Ash, and have a great weekend, everybody. Take care. Bye for now.
Take care, everybody. Bye-bye.
Bye-bye.